What Charles is doing at EasyEquities is democratizing investing. We can go every month and put 100 Rand and buy a fraction, I don't know, 0.001% perhaps, of a Bitcoin, if we like Bitcoin. I waited and waited and waited and waited, and eventually I couldn't buy, to buy one Amazon share, which was going to cost me 60,000 Rand. With Charles, it was easy. With EasyEquities, I just put 1,000 Rand in and I got my point whatever percentage. So this is something that we are seeing in South Africa is massively democratizing investment here, but it's also not just in South Africa. They've moved to Australia, where they're starting to take on the Aussies in their backyard. You might have heard of Robinhood, which I'm sure Charles is going to refer to, which is also in the fractional investing market, which is completely changing the scenario in the United States. He has always been an innovator. He has always been a disruptor. And it's almost like things were meant to be, because yesterday, for the first time, Purple Capital, which is the holding company of EasyEquities, went through 1 Rand a share. So what you're looking at here is the guy who's created a R1 billion plus company now. So congratulations, Charles. I'll give you Charles Savage.
Thanks, Alec. Yeah, I think they refer to a South African unicorn as a rhino, so we're a rhino now, which is quite nice. It's only taken me 20 years. In February, I turned 20 at Purple Group. But if I go back 20 years and just what drew me to the industry then has only presented itself as a real opportunity today. And maybe not quite today, but 6 years ago when we created EasyEquities. But 20 years ago, as I was building websites for .com, for e-commerce, and trying to convince the world that the future of finance, the future of commerce was going to be won on digital channels. And so I was selling websites to all sorts of industries. There were 2 industries that were really paying attention. The one was the travel industry, and I don't think any of us can even remember what the travel industry looks like before the internet. We don't go anywhere or book anything unless we do it online. And the other one was the financial services industry. Back then, the dialogue was that build online platforms and your customers will come. And those 2 industries were taking it really seriously. And so because I was building websites, most of my clients were either in travel industry or financial services. And what struck me is that in the financial services industry, there was this huge demand for people to own a piece of the economy through shares or through other structures. And the internet, for the first time, provided a platform that would democratize that access. And naively, I jumped ship and then joined Purple Group and was head of technology, and I went and built trading systems to try and democratize this access. But reflecting on the time in 2000, the ecosystem to drive that democratization wasn't in place. So back then, we were dialing up on 28.8K modems. I don't know if anyone remembers that experience, but it was pretty severe. And there were less than 2.5 million credit cards in the country, and transactional services online were really expensive and slow because access data, etc., was expensive and slow. And so actually it was more cumbersome to buy a product online than it was physically. And so everyone fell out of love with e-commerce, and .com bubble burst, and we all ended up losing a significant amount of money on the investments that we had made at that time. But the promise of what the internet could bring back in 2000 was obvious to me. And today, the excuses of the ecosystem have gone away. We've got low cost and getting cheaper all the time, access to high-speed data. Our smartphones are in our hand, they never leave us, so we've got the platform and capability right alongside us all of the time. And the technologies to support the ecosystem are evolving at a rate and pace of change that I've never seen before and I can't keep up with. And I think the mega trend that has emerged is that which is different from 2000, which was really an access play, is that it's the decentralization of digital finance that is driving this rapid democratization. And that fundamentally is contained in something like cryptocurrency, which we're going to talk about. Because what is that? It's the decentralization of money at its core, and the fractional access to assets. And cryptocurrency is the best example of a fractional asset. I mean, I think the decimal point goes to 18. In our fractionalization, we only take it to 1/10,000th of a share. But it's those forces, the decentralization and fractionalization of assets is creating this wave of democratization and speed of change that is, it's taken us 20 years to get to the point where the ecosystem is now strong enough to drive this rapid adoption and change. And we've just been fortunate to be in that space at the right time. And the friction point that it really addresses, which is one that, funny enough, and just to give you a quick history on fractionalization, is not new. It's been around for 100 years. The New York Stock Exchange, when they listed shares, recognized that as a result of corporate actions, you'd end up with these fractions. And so we've had fractions ever since we've had stock exchanges. But we've never digitized the process. We've never seen the value of giving someone a fraction of something. But in decentralizing finance, you've now got masses of retail consumers who want to take control of their own finances, and the access point for them has to be smaller. Because not all of us can afford a Berkshire Hathaway share, an Amazon share, a Capitec share, or a Naspers share. But we all want that ownership. We all want to be able to read. I mean, I was listening to you talk about Amazon Bezos. I mean, the best learning I've ever had is reading his report every year. And I got that learning from being a shareholder. And that could never replicate the returns that I've got out of his share, because the most valuable thing I've got out of Amazon is by far the education I've got by standing alongside Bezos as a shareholder. And that's what fractionalization enables for everyone, is this, if you've got R1 to play, you can play alongside Musk, Bezos, Gerry from Capitec, or any of these inspirational leaders as a shareholder, and you've got an entitlement and a right to ask them the questions that you want to have the answers to. And I think that the point of ownership is often, people reflect on it and say, well, the reason I want to own these shares is I want to make a whole lot of money. Well, you're not going to make a whole lot of money with owning R1 of a share, but it is going to drive, and it is driving, radical education. That radical education is driving incredible engagement, and that engagement is creating a behavior with young investors now, 12-year-olds, that is creating understanding of an asset class that is going to pay them in the same way that it paid Buffett, when he started his investment journey. So for me, the fractionalization came out of the desire to democratize access, and the realization if we're going to democratize something, we have to give everyone the same right to enter, and if we're going to give them that right, we have to make it affordable.
Why did nobody else do that? I can remember buying shares only in lots of 100, let alone one.
I mean, I've reflected on this. I wish I'd done this in 2000. Maybe we'd be a dollar unicorn. But I think, again, it goes back to that ecosystem. It's easy with hindsight. I look at it and say, well, I'm sure we could have done this earlier, but actually, I don't think we could have done it much earlier. We were the first in the world, funny enough, to do it. We were the first to enable digital access, online access to buying fractional shares.
When was that?
2014, 27th of October 2014. We sold our first fractional share. And what's interesting about it, and with hindsight we can connect some of the pieces, for us we were solving a very specific problem. There are millions of South Africans who want to own shares who cannot afford the access point. That was the problem statement. But with hindsight we can reflect on what's actually happening, is that all of us start our engagement with an asset class with small amounts of money. Well, you should, because you don't necessarily understand it, haven't experienced it. And so fractionalization enables access for all of us, not just the low-value customer or the young customer. For example, I'm not a massive crypto fan. And so I started by owning a very small piece of it. And that piece was enabled by fractional access on our platform. As I've stood alongside it, I've experienced it, I've sought to understand it, I've asked more questions of it, and so my understanding has grown, and so my investment in it has grown, and now it makes up about 3% of my portfolio. But with hindsight, fractional access should have come along sooner, but I think that the ecosystem to do it wasn't in place.
So it's skin in the game, really.
It is. It's skin in the game, and it's, for me, I think a lot of people, I've never learned anything by reading books that I haven't learned faster by standing alongside the best players in the game. So everything that I've done in my life, I've surrounded myself or given myself access to people that are really good at doing things. I love reading, and I take those lessons, but they happen slowly for me. Experience accelerates my education and understanding. And I think fundamentally that's what ownership does. Because when things go up and down and you've got skin in the game, you take notice and you ask questions, and that engagement drives to understanding, and that understanding drives to better investment behavior. And we're seeing this in such a radically disruptive way, because as we get bigger, so let's go back to 2014 when we launched. Our first year, we onboarded 10,000 customers and 100 million in assets. That was 6 years ago. In February, we onboarded 60,000 customers and 1 billion in assets. And we're onboarding 2,000 customers a day. What's the momentum? What's driving that momentum? 65% of our customers are referral. So that's all of you talking to all of your friends and family. And what's happening is that people are being influencers in their communities, and they're starting the conversation. That conversation is driving driving people to take up a stake in the economy, even if that starts at R1. And then that's creating the engagement for those conversations to continue. And what we're seeing is our business is exploding in social places that we didn't create. So there are 4 Facebook groups, there are many more, but there are 4 big ones. All of them have over 100,000 community members, and their sole purpose is to talk about shares and investing. To give some context to that number, when we started EasyEquities, there were only 280,000 retail investors in South Africa, total. And we're enabling 60,000 new investors every month. We're creating a new JSE every 4 months.
Are you being helped by the JSE?
Yeah, so to start with, no. To start with, nobody believed. And in fact, I sat with the JSE, and I sat with asset managers, and I sat with brokers. And the dialogue was that we were being irresponsible. The dialogue was that retail investors were too stupid to take ownership of their investing. And what they were focusing their attention on was the lowest common denominator, a 12-year-old kid, in my example, taking up shares and investing. And so there were lots of friction points in the ecosystem that tried to prevent us from going live. I mean, we ended up spending 5 million rand on legal fees before we launched because fractionalization didn't exist. So we had to create legal contracts that defined it. We had to get them sanctioned, not approved, but sanctioned by the regulators. And in that process, we came into sight of all of the regulators, the JSE, the FSCA, and at all points there was an enormous amount of friction not to prevent us from going live because they were terrified of the consequences of allowing millions of South Africans to invest. And I was terrified of not enabling that. I was going, if we don't allow people access to the economy to take ownership, then what's going to happen? And I think, and this is where I think the dialogue is shifting really differently today, is that 6 years ago we worried about the risk of people investing. And it was the only risk that we considered as financial services practitioners. I mean, I remember sitting with the head of Alan Gray at the time, and we got into this heavy argument about what we were doing and what he was doing. And we believe that your assets, we must ring fence them from you. We mustn't make the access point easy. It must be difficult and cumbersome so that people don't pitch up and check on their assets. Because if they pitch up and check on their assets, they're going to do the wrong things with their money. And the truth is exactly the opposite. And so the dialogue is now shifting to what if we don't invest? If I'm a 12-year-old kid and I'm not making the first steps towards investing, then what is that going to have? What impact is that going to have on me as a 60-year-old adult? And for me, Buffett is, I know you're a big fan. I'm also, I think, probably his second biggest fan after you. But he was asked once, what's the biggest investment mistake he ever made? And his answer was, I wish I'd started younger. I mean, he was 11. And think about the world that he waded into when he was 11. The stockbrokers, it would have been illegal. Interestingly, it's still illegal in America for an 18-year-old or younger, a kid, to own shares. So we can't enable access to US shares for South Africans. In South Africa, one of the few countries in the world, it isn't illegal. You have to have a guardian consent, which we do. But we've got 30,000 clients under the age of 18 that are investing for themselves. And in my mind, I'm not going to be here, but can you imagine the outcomes, the economic outcomes that that's going to create in this country 60 years from now?
That's incredible. the best investment you can make, Buffett said, was in yourself.
Yeah.
So this investing in parallel or alongside being a co-owner of a company is extraordinary. But before we go into crypto, your own story, you've managed to have a partnership with Sanlam, which in itself is very exciting, and maybe you can explain that. And I'll just to tell you, Charles's competitors said to me, Sanlam are going to dump their EasyEquities shares, which sounded real cool, and that was the story that was going around the market, and I think it was depressing your share price as well, until we got Paul Hanratty, who was the CEO of Sanlam, onto a webinar, and one of the first questions was, well, how do you feel about EasyEquities? And he was in raptures about the participation, and he certainly wasn't going to sell the shares. But that's one, we have, many people in South Africa have this perception of Sanlam, which is very different to perhaps your experience. And the second thing was that transformative deal that people haven't kind of clicked on yet with Capitec. So take us through the two of those, because I'm sure you're talking to a lot of entrepreneurs and a lot of business people here who could learn from that.
Yeah. Right from the start when we built EasyEquities, because our purpose was to democratize all things investing, we recognized that we didn't have the brand or balance sheet to do it alone. Like, we just didn't. I mean, Purple Group at the time was a probably 20-cent share, so 200 million market cap, with no cash flow. I mean, its profitability was probably 15 to 20 million a year back then. So that was our foundation. And our shareholders wanted dividends and returns, so I couldn't use the whole income statement. But we recognized we couldn't do it alone, and so we built the platform to partner. And it's probably it's the weapon in our attack that is the sharpest. None of our competitors, you mentioned Robinhood, none of our competitors globally have built their businesses to partner. So you won't find Robinhood inside Capitec Bank. So for us, the catalyst for our growth first came from the first wave of customers, the early adopters, and the fans that they became. The word that they chose to describe the business was love, literally, that we gave them all of the words, and they said, we love EasyEquities, which was really cool. And funny enough, we surfaced in front of Sanlam because of that statement. People were buying Satrix shares and tweeting them in social media, and Sanlam took notice of what was going on, and they approached us and said, look, Charles, you've built this great platform for investing in equities. Do you think you can create it or segment it and do it for ETFs, for Satrix? And we said, yeah. And they said, well, how much is it going to cost us and how long will it take? And he said, well, interestingly, we've built this business to partner, so we'll give it to you for free and we'll do it in 6 weeks. And they laughed at us. They were like, whatever. And 6 weeks later, we launched Satrix Now, 1st of December 2015. And through that engagement, I think we proved ourselves to them, and they bought some exclusivity from us for a period. It was 18 months, and as that exclusivity period ended, they approached us and said, listen, we'd like some more exclusivity. Like, we want to own this platform capability for ourselves inside Satrix. And I said, look, that's not how we democratize something. So if you want exclusivity, then you must join me as a shareholder and you must fund the runway to profitability, which was a bold ask. It was a 100 million rand ask for 30% of the company, and we were losing at the time 20 million a year. And that's really hard to raise money in a company that's losing money, especially in South Africa. The Yanks are really good at it. So Sanlam came in, they bought into it, and they've been an unbelievable shareholder.
What gave you the guns to do that?
20 years of trying to do this. When we put our customers up, and I keep going back to our customers because they're the real asset. The platform capability is interesting, but you can copy it. If you look at it long enough, you'll find how to do it. But what you can't copy is our community. And when I talk about our community, I'm not just talking about it's our shareholders and stakeholders, it's our staff and our customers. But when we put them in front of our investors, we were so radically different from what everyone expected. We were closer to Coca-Cola than we were to Absa Bank. Our customers it was a service, it wasn't a grudge purchase. Financial services typically are grudge purchases. We don't fall in love with our insurance companies or our stockbrokers or our banks. But here was a business where the customers were falling in love with. And Sanlam, I think, recognized that really early. And I think for them, 100 million rand is a small bet. When you look at the size of... And they said, if we get it wrong, what we've done is we've bought 100 million rand platform capability for Satrix. And we can probably write that off. So they took a small bet in their terms. But what they really saw was a team that was capable of doing things differently to the way they were doing things. And if we got it right, they would have access to this asset. And they do. I mean, they're a 30% shareholder. They've got negative control in the sense that anyone else who wants to acquire it has to go through Sanlam. So they're the gatekeepers, I guess. But they've fallen in love with it themselves, and we work within their ecosystem to do more. For example, in Australia, we operate under their licenses. In South Africa, they own Glacier, which is the largest unit trust platform, and they were the first unit trust to allow access to ETFs. That's done through us. So it's a symbiotic relationship that's proving. And the key thing with them is they have, and this is something that I didn't think would happen with Sanlam. I thought that the minute we put them in the room, they would be the gorilla in the room, and they would control our decision making. And that was the risk of taking the money, but we needed the money, so we couldn't say no. But they haven't been that at all. They stand behind us and give us all of the support we need, and their questions are insightful and direct us to look after elements of the business that we're not that focused on. So for example, they'll do things like due diligence, the platform capability from a security, stability perspective, and they do that with much more dedication than we do it, because we're really focused on the growth aspects, on onboarding customers and the like. So Sanlam's been an incredible partner, and they certainly gave us a level of trust in the industry that we couldn't have bought in a short period of time. And then that led to other partnerships. We did one with Bidvest Bank, which hasn't worked really well, but Bidvest Bank have had their own challenges internally. I think they'll get it right, and we're inside Bidvest Bank. But then Capitec I'm smiling because it's the most incredible deal. I still pinch myself about the deal because it happened. It was 2018 December, and 2019 December 2019. And the head of innovation at Capitec Bank had phoned us. He was a customer of EasyEquities. He'd got through call center, and he'd got to me, and he phoned me, and I was literally about to go to Mozambique on holiday, and he phoned me and said, look, Charles, you don't know who I am, but I'm head of innovation at Capitec, and all we want to know is would you like to partner us and put EasyEquities inside Capitec Bank? And we were like, is this a joke? Like, are you because and I'm going back again, when we started EasyEquities, we put a couple of names on the board, say who would be the ultimate partnerships, and Capitec was top of the pile, and now they were phoning us. And I said, yeah, of course we'd love to partner you, but what's the deal? How does this work? He said, no, we're building an ecosystem of partners that we believe in, that we want to show to our customers, pass on to our customers, and we think you're the best one to be first in that marketplace. And we just want to know if you're interested. And so I spent my whole December worrying about what does that mean. And then we came back in January, and we did a deal. It took us 2 weeks to negotiate the deal. And it was incredible. Like I can see why Capitec is so successful. Firstly, Gerry was alongside the deal the whole time, and I thought, I thought he'd be too busy doing other stuff. And the second thing is, at the end of the deal, they were difficult in the engagement in terms of making sure they got the right value out of concentrating the deal. And at the end of it, the economics they'd negotiated for themselves, they withdrew from. They gave me more back. And they were like, we just wanted to make sure we were getting a good deal, and now we want to make sure you feel like you're getting a good deal. And they've given, the deal is crazy. It is.
That's extraordinary. I haven't heard of that before in the South African context. You
No.
do hear more far-sighted companies perhaps elsewhere in the world.
I think it's because I think what they see in EasyEquities is a value proposition that will keep their customers at the bank. And so for them, it's not about the economic value that it creates out of their customer base. It's about the stickiness that it's creating for their customer base. And Capitec's long-term objective is to democratize access to private banking. If you see their shift in products and services from micro-lending to where they are today, the future is private banking for all South Africans. And at the center of that future sits EasyEquities, because if you're going to have private banking, you're going to have access to assets and fractional access to assets. And so I think they see us at the center of that strategy, and they also recognize, they're a highly disruptive digital bank, and they know what that income statement needs to look like to drive that disruption. So if they were taking the lion's share of the economics, they would have been shutting down the disruption income statement, because we weren't profitable when we did the deal. We're profitable today. So I think Harry understood that in giving us the lion's share of the economics, he was enabling our disruption, and by enabling our disruption, enabling his business plan. And they're just not what I expected in dealing with a bank in South Africa, because I've failed to do a partnership with any other bank in this country for 20 years, and I've tried.
Did you even look? You have tried.
Yeah, we've tried. You know, I think the South African banking mentality is if you can do it, we can do it better. And that's what they've missed is that the world is moving so fast today, is that you can't do it faster. You might be able to do it better, but it's going to take you longer, and your customers aren't going to wait for you to do it anymore. So the fintechs, the edge that we've got is speed of execution, and that speed gives us massive competitive advantage over the banks. And the future of banking is going to be unbundled. And you know I guess that's why crypto is such a threat to the banking system, is because we're not going to buy banking service in this bundled way. We're not going to do what the banks want us to do, which is we're going to do our asset ownership, our lending, our transacting, our mortgaging, all of that stuff in one place. It's not going to happen. The future of banking is going to be delivered through fintechs, in my view, that have partnered through an ecosystem platform play, let's call it Capitec, where the best in breed, the customers will choose best in breed to deliver those services, and completely unbundled. And that's why I think Gerrie sees that future, where the bank isn't every part.
Getting onto cryptocurrency, just take us through an idiot's guide to what crypto and Bitcoin is, why you've put it on the platform, and what you think about the rest of us should be doing. You said you got 3%. Pitt said 1% maybe is a good place to start of your portfolio. Yeah.
Look, the future of money is 100% going to be won in crypto. And I'm convinced of that. There is no doubt in my mind that the future of money looks more like crypto than it does fiat, for a whole lot of reasons. And again, go back to my analogy, go back to .com 2000. This is exactly how e-commerce felt 20 years ago. People could see it, but didn't necessarily believe it. And so the early adopters, who bought Amazon back then, are all billionaires today. I didn't buy Amazon back then. So this time I am in, and I am buying, and that's why we created EC10 and put it on our platform, because we do think you need to have a stake in the game. But why is crypto going to be the future of money? In fact, I think crypto as a title is the future of all digital assets. And crypto has got there are lots of different areas of crypto. The one that gets all the attention is cryptocurrency. But there's more and more emphasis coming around digital assets, crypto assets. NFTs is the non-fungible tokens that are taking up the landscape, and other forms of tokens, fungible tokens as well. But the friction points that cryptocurrency address, firstly, this decentralization of central banks, is built on the basis that people have lost trust in the central banking system. And those people are still in the minority. I mean, the adoption of cryptocurrency is still tiny, despite this incredible price rally. But the adoption numbers are still small. I think 70 or 80% of the world have not touched cryptocurrency. I think it's even higher. 90% of the world has not bought a cryptocurrency yet. So we're still in the very early .com days of cryptocurrency, which means that we are going to see continued radical volatility and change, because we haven't worked out who's going to win. And Bitcoin owns the dialogue. I mean, I was looking at the stats. 97% of all investment last year in crypto assets, so all crypto assets went into Bitcoin. Bitcoin is now $1 trillion market capitalization. Go back 4 years ago, it was 1/15 of that. But Bitcoin doesn't solve all of the problems around digital currency. For me, digital currency, the beautiful thing about it is its settlement. It's immediate. You and I pass money to each other. We don't need an intermediary, and it happens now, instantly. That in South Africa, we think that that's normal because our banks sort of do it. Not quite instant, but close to. But you must go to places like America where banks sit on your money for 2 days. And early settlement is a novelty. You get it quicker and you pay for it. But when you get out, the more you look around the world, the settlement of transactions is slower than you'd expect. Even in places like Europe, where you've got your single currency, the banking system is not plugged in perfectly because they all came from disparate banking systems. So the big friction point for me about digital currency is that it allows us to move money freely and easily. And I think the South Africans, having locked down our money for so long, that's something that inspires us or evokes us to want to own more of it. So that's the big friction point. There are lots of things that are standing in the way of cryptocurrency being massively adopted. Regulation, we don't know where that's going to surface. It's moving fast, but regulation could completely undo it. You've got the early parts of institutional adoption. Mass retail adoption won't happen until there has been at least a high proportion of institutional adoption. You're starting to see that. Tesla, $1.5 billion in Bitcoin. He's made more money in Bitcoin than he has by manufacturing any cars in a couple of weeks. But you're now starting to see Morgan Stanley and Goldman Sachs enter the fray. And again, 4 years ago, they were the naysayers. They were saying, forget it, it's not going to happen. You're now starting to see central banks. China central bank has adopted a digital currency in one of their states, regions. I can't remember the name, Shenzhou, I think, where they've done a sort of social experiment where they've issued cryptocurrency in the region, and they're watching to see how this works or doesn't work. You're seeing it in Switzerland as well, thinking about it, and Europe. The euro, considering a digital euro. So the future of money is 100% crypto. Is it Bitcoin? That's the $1 billion question. I don't know. I couldn't pick Amazon 20 years ago, so I'm not going to tell you I can pick which cryptocurrency is going to win. The emergence of new ones and the adoption of new ones is radical and fast, and so Bitcoin, as quickly as it has landed on the landscape, it could be displaced by another one. For me, right now, how do I manage my access to crypto? Very simply, I buy the EC10, which is the Easy Crypto 10. It's managed by a guy called Earl Loxton, it's a company that was created between him and Michael Jordan. And what it does is essentially goes and buys the top 10 cryptocurrencies by market cap and contains them in essentially an unlisted ETF, if you like. And because they are monitoring the market and reweighting the portfolio based on market cap, I don't have to worry about what the next crypto coin is going to be. I'm going to own it because of the market cap. So I don't spend any time worrying about whether Bitcoin is the future of money, but I spend a lot of time thinking about how we can use cryptography and blockchain to improve digital asset ownership. And this immediacy, settlement of money, and access and irrefutable ownership of an asset using blockchain is incredible for me. That is going to be the future of how we own everything. Houses, cars, everything. Your asset manager will manage your portfolio on the blockchain because it's transparent, it's access, it's irrefutable, and that's the way we're going to own everything. And I think those, for me, those are the much more interesting aspects of cryptocurrency. Is what's the best application of that technology, and that's where I focus my time and energy on it.